Instead of being fractional in terms of time, so one occupancy, we're fractional in terms of space. So, rent by the room. And it's targeted towards long-term renters who live in the community.
Hey everyone, welcome back to the Real Estate 101 podcast. As always, I am your host, Robert Leonard, and with me today, I welcome in Frank Furman. Frank, welcome to the show.
Thanks for having me. Appreciate it.
I'm looking forward to our conversation, and we're going to talk about a little bit of a different real estate model that you're doing with your company, PadSplit. It's different in some ways, but maybe similar in others. One of the things I like about it is that it can help people house hack with a rent by the room strategy. But let's dive into the co-living model a bit more. What makes PadSplit different than renting a room on another platform, like maybe Airbnb or VRBO, or even a hotel room?
It's a great question. And to a large extent, there's a few things that, co-living seems exotic. There's sort of this perception around it, or people ask us all the time, how did you invent this? How do you think about it? Didn't invent it. It's been around forever. It's older than you. It's older than me. It's older than our parents and grandparents and so on. And realistically, not only have people been doing it forever, it's really something that, people ask, I should ask my kids about it. They understand, sharing economy. I'm like, no, ask your grandmother. Because if a woman was living in the 60s and she was a typist in New York, she didn't rent an apartment. She boarded. And if a guy was working in a factory, single, before he had a family or that kind of thing, he boarded. That's what people did. So this isn't anything we've invented. It's something that's always been with us, but by and large has been frowned upon in kind of building code and zoning and just kind of culturally. But, when you unpack it, you think, well, hey, I did that when I was in school, or hey, I did it with friends and so on. But some of the gap that we're trying to solve in the market, and it kind of gets to how we're different from Airbnb and hotels, is that, for example, I was in the Marine Corps for years, and before I was married and had a bunch of kids and all that, I'd rent a house and I would split it with buddies. Nothing crazy. It's something we've all done. We all paid our share. The lease would be my name, but it was no big deal. When I was in grad school, I did the same thing essentially, but as a relatively high social network kind of person with a college degree, relatively clean cut or part of a cohesive group like the Marine Corps where you have a bunch of colleagues that you kind of work with. It's pretty easy to do that, right? It's easy to go to a new place and say, hey, I'm part of this group. How can I live here? How do I get a room? All those things. We really serve an underserved part of the market, right? People who are trying to get their footing, but maybe don't have college degrees, don't have those social networks or family connections to lean on, but still have that same need for affordable housing that I had as a poor graduate student or as a young officer in the military. So it's really kind of solving that problem that maybe you or I or lots of people can solve on their own, but a certain part of the demographic can't. And so that's really what we do. Now, how do we differ from Airbnb? Our core offering is similar, right? We're a housing marketplace. On one side, you have landlords, they're listing a property. On the other side, you have people who are going to be residing in that property. What's different is instead of being fractional in terms of time, so one occupancy, we're fractional in terms of space. So, rent by the room. And that results in all sorts of implications, right? When you look at the feature set, a lot of what we've built that's unique to us is how do you get people to live together, if not always harmoniously, at least, in peace and with communications and with feedback and accountability mechanisms. So roommates can rate each other. They can submit maintenance tickets. That's something you don't really have with Airbnb because it's, short term. And it's targeted towards long-term renters who live in the community. So unlike, say, an Airbnb or any sort of short-term rental situation where you're generally marketing to people from out of town, people who are vacationing or what have you, who don't live in that community, we're looking for people who are already in that community. So just from a marketing and targeting perspective, we're seeking a totally different kind of person. And what that looks like is general kind of workforce, frontline folks, security guards, people working fast food, hospitalities, teachers' aides, that sort of person who maybe is new to town. We're predominantly in sort of the Sun Belt. We have people who move from Detroit to Atlanta or to Houston looking for work and maybe don't have the family connections or networks to lean on. And they aren't making enough to get over that really pretty high bar to get your own apartment. And when you think about the challenges in the housing market, it really comes down to supply and access. So supply, we can go on for days and days about that and how hard it is to build and so on. We're increasing the supply by obviously getting, better use out of the assets. But the other one that people don't talk about as much is access, and that, if you want to rent an apartment, even a relatively low cost one in really any city, you typically need 3 times rent as income. Okay, fine. Usually have to do at least first month's rent and 1 month security deposit. And then you get in, you have to furnish it. You've set up all your utilities. There's deposits for utilities. Even if it's $1,000 a month rent, which is about as affordable as you can get in any metro area, you probably need at least $3,000 to get in the door, right? And that's before application fees and all that kind of stuff. So for us, by having furnished units, by having kind of shared utilities that are already set up, you can really kind of bring that down and open up the aperture to a much wider group of people, while still delivering generally about double the net yield for investors, which is how we solve the problem. And but to a large degree, we're similar to Airbnb, smaller in fairness, but in terms of the way that things are structured, the same. I mean, we rely very heavily on our hosts, and we use the same term because we stole it from them. And I have a lot of respect for what Airbnb does, in that they understand that the hosts drive a lot. And they're focused on host returns and hosts having good experience, and so are we. Our conviction is that if hosts are on our platform, they're having a good experience, they're generating a great yield, an above market yield, the problem's solved, the supply problem, because they are incentivized to do more of it, tell their friends. And that's really our growth engine. So by being hyper-focused on host returns, host experience, they're incentivized to provide a great experience for the residents, because that's who pays the bills. And that's kind of the virtuous cycle we're seeking.
I actually had somebody who I think was I believe they were a fan of the podcast. They reached out to me, and we hopped on a call for a couple minutes, 15, 20 minutes. And I think they were a landlord on PadSplit. I believe they actually purchased a few properties and were renting them out through PadSplit. And so when your email came through to come on the show, I was like, why do I recognize that name, PadSplit? Like, has Frank been on the show before? And I look back, I'm like, no, he hasn't been on the show. And then I remembered this conversation. I actually have had a conversation with somebody who was a landlord through PadSplit, and from what I remember is he had all great things to say, and he seemed to really be enjoying it, and he said the returns were really good. So yeah, it was interesting to kind of connect the two.
We probably had to pay heavily for that referral. I'm just kidding. I'm sure I know who it is. But you don't have to out them in the show. But we have a band of very dedicated hosts, and really it's I think part of it for us is we came out of the real estate investment space, so we always had that focus, in terms of how we started the company. And so some of the things that do make us different from Airbnb and other kind of marketplaces in general is, when we started, we thought, hey, we got to think about financing. That's the world we came from. How do you, if people can't refinance these properties, there's no business. So how do we start with that? How do we solve those challenges of the ecosystem? These properties may be modified. How do we get general contractors trained to know kind of the co-living model and what kind of hardware you install and that kind of thing? How do you work with lenders and insurance companies and really build out that ecosystem to where someone could come to us today and say, hey, I get it, I'm interested, but I need a little bit of help. I need to find who's an agent who can help me, who's a GC who can help me. How do I get refinanced? And by kind of relying on a lot of that ecosystem, we can kind of help them through that journey.
I want to talk a bit for a second about that. You guys being a marketplace, I love learning about businesses. So I spend quite a bit of time studying it. And what I've learned, or at least what I've seen, is that marketplaces can be a really tough business. They can be really lucrative. There's a large network effects there. So once they hit scale and you have traction, they can be really lucrative. But at the beginning, it can be tough because there's this chicken and egg problem. So in PadSplit's case, I'm guessing you kind of face the same dilemma. You go after the tenants or the host first, right? If the tenants go on the platform and there's no hosts, then they might not come back. And if the hosts list and there's no tenants to fill their space, they might not come back either. So it's like this really chicken and egg problem. How have you managed this as you've grown PadSplit?
Yeah, I feel you've been spying on our exec team meetings. No, it's always a concern. You're absolutely right. And for us, we look at it as a supply challenge, the host. So our conviction is that there's a huge unmet need for affordable housing generally, but just for this kind of model specifically. And so we've always had this just really kind of core belief that if we magically added 100,000 units tomorrow, that'd be great. We would panic a little bit. I'd be in the fetal position for a while, but we'd be able to fill the rooms. There are people out there who need it. Maybe, how do you screen? How do you find people efficiently? How do you market effectively? All those things are problems, but it's not a question of is there demand. It's just how do you find it and how do you kind of validate it and all those things. So we've always seen the supply problem as the big challenge for us. We find the houses, we'll assume that people are there. And generally that's been borne out. I mean, another interesting subset of it, because you're right, marketplaces are a challenge. And I had many fewer gray hairs before we started this venture, but it's really how you get started in markets. Because to your point about network effects, they're 100% real, and real estate is hyperlocal. And when we started the business, we looked at this. There were kind of two rational businesses, right? Door one was, let's do it ourselves. Let's create a real estate kind of full stack company where we will buy, renovate, manage properties. Okay, fine. Or let's be a marketplace and be the Airbnb of this model. And what we really saw as the challenge of being the full stack kind of fund is that real estate is hyperlocal. And sure, we could do it in Atlanta, where we're based out of. We know that market well. Maybe we could do a few kind of other markets, but you'd have to be deep in a market and really kind of understand it and not be all that spread out. And we thought, hey, if we think this is a moonshot, we think we can be everywhere, and we think this is a need everywhere, we're going to have to rely on local investors who know their markets. Because even in Atlanta, which I know pretty well, and I've lived here for a while, there's 83 different municipalities in Metro Atlanta. Even within the city, you have street to street, different, it might be, hey, this road's fine. This one's a little bit not as fine. Hey, this one's an issue because of this. So we've gotten a lot of leverage, and our belief is that working through local investors who know their markets, know who to go to in permitting, know, which GC is great and which one's not so great, and all those things is just really important to doing it well and providing a good experience and kind of meeting, being compliance with the fabric of communities and that sort of thing that reduces neighbor complaints. I mean, when you look at Airbnb and some of the challenges that they've had, whether it's not necessarily ascribing blame, but it's a condo association. It's neighbors saying, oh, this is a party house, or the parking's not here and this or that, or it's someone from out of town who's kind of running this thing and we don't like it. By working with local investors predominantly, and we kind of take all comers, you can kind of mitigate a lot of that, because we'll talk with hosts and they'll say, oh, I can't do it here. This area, they'll complain about renters, so it won't be worth my time. Or, oh yeah, hey, here it'll work fine. And that insight is really hard to scale. You need to sort of crowdsource it.
Yeah, the gentleman that I was mentioning earlier is actually in Atlanta. Now that you mentioned you guys are in Atlanta, I do remember him being based in Atlanta. So how does PadSplit make money in this model? What is your guys' business model? And if you can, give us a bit of insight maybe on the scale of your business, and you can talk revenue if you want. That's always interesting, but if not, that's okay. Sure. Maybe give us some unit counts, things like that.
Yeah. So we make money the exact same way that Airbnb makes money. We take a percentage of essentially collected rents, right? Percentage of revenue. And we take the exact same percent that they do, 12% net. Now they kind of split it up and kind of play both sides, but
is that by design? Did you set that percentage because of Airbnb?
Yeah, absolutely. We said, we looked at their SEC filing when they were going public. They took 13%. We thought, well, we should probably be less than that. So we take 12. That's, you're looking at the extent of the analysis that went into it in terms of take rate. So, but the model's exactly the same, right? We take a percentage of what's collected, and that's kind of that. We have about 5,000 doors today. And by doors, I mean bedrooms, which is how we kind of think about it, because that's our revenue generating unit. Which comes out to, a touch over $10 million in revenue on annual for our take of that marketplace. So that's more or less how we think about it. We're to our knowledge, the largest co-living marketplace in the country today. There's, you could say there's student housing companies that maybe have more doors and that kind of thing. But in terms of like really what we think of as our market, we think we're the biggest, and we're the only one focused really on workforce housing.
What do the properties look like? Are they mostly like 2 bedrooms? Or are they more like on the other end where they're like 5 bedrooms and, the person lives in one and they rent out 4, or is there a mix really of all of it?
So it's a mix, generally on the larger side, though, for unit economics reasons. So it's, in general, if you have a 2 bedroom house, your highest and best use is probably to keep it as a traditional rental. Huge demand for 2 bedroom units, and you don't get the leverage by kind of dividing it up, really. You get the pain of co-living and, hey, I've got multiple people and, who does what, but without a ton of upside. So generally you're seeing that even more than 5 bedrooms, 6, 7 bedrooms, is actually quite standard in a lot of areas for what we're doing. And in general, it's all kind of investor, like non-owner occupied properties. We do have a few that are that way, and that's fine. But the vast majority of the properties are, you own the property, it's being managed by a property manager or yourself or whoever, but no one in the house, the owner doesn't live in the house. Everyone in the house is a renter, and that's. We've really kind of built out our feature set to allow someone to do that. So they don't have to be, when you live in the house, a lot of the technology isn't really needed because you're there. How do you worry about comms? Well, you can knock on someone's door. How do you worry about messaging the whole house? You can just shout. How do you know which car belongs to which person? Well, you can just ask, that's fine. But for us, we really wanted to enable the harder use case, which is, hey, here's an owner who lives in New York and a property manager who, operates in Houston and the house is in Houston. Okay, how does the owner in New York see the financials, see what's going on, see the comms, see the maintenance tickets? The property manager can kind of work through all of that and they can all be on the same page.
So do you guys have to go into a new market before you allow a host to list there? So like, let's say there's some town in I don't know for sure if you guys are in Texas, but let's just say there's a small town in Texas, right? That somebody wanted, a host came to you. They're like, hey, I own this 4 bedroom single family house. I want to list it on PadSplit. Yep. And would you guys be like, hey, we're not really in that market yet. So we can't guarantee that we'll have any tenants there because we don't really have a pool. Or do you open up a market first and then let people come in? How do you guys manage that?
Yeah, great question. Today, because we're so focused on investor returns and having that great experience while we're still at a relatively small size, we're pretty conservative about where, and very intentional about which markets we're in, both for regulatory reasons and just because we want those good outcomes for investors. So we are in Texas, we're in Houston, we're in DFW. But anytime we go into a market, we like to go in with an anchor investor. So someone who's local, someone who's tied into the local real estate community, so we can get those network effects going, but someone who's going to be there whether we're there or not. So for example, we just launched Las Vegas as a market. We hadn't really had our eye on it too much. This investor came to us and he said, hey, I love what you're doing. I'm interested. I own 100 properties. I want to start bringing on a few that are PadSplits. And he's a home investors franchisee. He's very tied in to that world. And we said, okay, sure. We'll be pulled into a market. He's a very capable guy. He has, his own crews. He's a real operator, not just an investor. And it's gone really well. He knows the market, ins and outs, who can get something through permitting, who can't, that kind of thing. And that's really the core. So we get in with that anchor investor and then we branch out to new investors and so on. So we can be opportunistic around markets, but if someone came to us and said, hey, I'm in Whipple, Texas, and I want to open a house, we would probably say, it's probably not such a good idea. Whether or not we let them, and it's not tied to Houston proper per se, more of the metro area, but it's definitely a concern. I mean, we don't want, this business does have network effects, and we have marketing spend that goes into supporting hosts in every market that we're in. So we want them to have good outcomes. So for us, it's important to be very intentional about where we are, which markets we're in, so we can just have a good experience for everybody.
I'm sure that it's going to vary a lot from market to market, but just generally, what are you seeing for vacancy across a portfolio? Let's say a host comes to you, and what do you usually target or tell them for a vacancy rate? And how does that compare to maybe a long-term rental where in a good market, there's, often very little vacancy. And then how does that compare to maybe a short-term rental where there can be, 20, 30% vacancy?
Yep. So our stabilized vacancy today is 5%. It's certainly shorter term than a traditional long-term renter in that our residents stay about 10 months on average, and you generally see 2 years and change for kind of standard rentals. So you have a little bit more churn on that front, certainly much longer term than, say, short-term rental. But 10 months on average. We have people who stay for years. We have people who stay for a couple months. It kind of comes out to the middle. It's bimodal. But yeah, I mean, I tell every investor that I work with, underwrite to 85% occupancy or 15% vacancy, because I'm a conservative underwriter, and you have a lease up period and all those things, and we pride ourselves on doing it really quickly. But my view is always you shouldn't be a little bit better than your alternatives. If it's a lot better, okay, it's worth your time. Let's do this. I'd rather set the bar super low and then leap right over it. And it kind of we sort of a natural conservatism about what we do because we're real estate investors by trade. And we don't want anyone to look at it and say, okay, if everything hits, I'll do well. It's like, no. This is the real world. Things go wrong. You always have CapEx and all these different things you didn't plan on. So underwrite to 85% or 80%. And if you still feel good about it, if you're still exceeding what you would make as a traditional rental, I think that's great. I mean, I generally tell people you should be 50% better, higher NOI than a traditional rental. And if that's true, let's run with it. And, usually it's about double. So, but in like today we are at one of my numbers. Yeah. 5.5% vacancy across our network.
What's the kind of long-term future plan for PadSplit? Are you guys going to get into owning any of the properties? For me, like when I was researching the business, it kind of seemed like almost like a no-brainer in a sense of like you buy a bunch of properties and you PadSplit them. I mean, that's obviously a totally different model. It's a lot more capital intensive, it's asset heavy, et cetera. So I definitely see the downsides there.
Yeah.
And whereas right now you guys are super asset light, probably not very capital intensive. So I can definitely see the pros and cons, but I'm curious if that's in the growth strategy for you guys.
So we do have a sidecar fund, separate balance sheet fund that owns about 8% of what's on our network. So it is a growth lever for us. Our view has always been it can be helpful. It's sort of our laboratory in a lot of ways. There's a certain kind of passive investor that doesn't want to be an operator and may just want to put cash into it, and that's fine. But it has to be a part of the strategy, because ultimately our fund can never be as nimble or as opportunistic or as locally knowledgeable as real estate investors broadly. So we're incredibly ambitious. We want to be everywhere. We have 5,000 units today. We want 1 million units. We're not going to get there with a fund. Too much capital, too much, street by street kind of local knowledge that's required. And to do anything at scale, it's hard to be opportunistic. You have to kind of open that aperture. So we do both. The answer is today, but our focus is really on being a marketplace.
I noticed that you guys do weekly payments instead of, or biweekly instead of just one monthly payment. Why is that?
Really? So it comes out of this idea of customer focus in a way that most landlords don't think about. So, I'm a landlord, so, I come by it honestly, but most landlords are a little bit lazy, right? Why do you bill on the first? Well, because I've always done it that way, because my bookkeeper likes it, my lender likes it. That's why we do it. But when you think about tenants, and in particular, lower income, lower financial literacy tenants, well, when's the first of the month? I'm not really sure. But when's Friday? Well, Friday's tomorrow. And I get paid on Fridays and my bills due, okay, fine. It's kind of much more intuitive, much more top of mind, especially for people who are paid kind of weekly or biweekly. Now, so what we do is we let tenants set, our members, the residents, set their pay date whenever they want. If they get paid on Wednesdays, they can have their bill come on Wednesdays. That's fine. If they get paid biweekly, they can have their bill come biweekly. And we manage, you figure that 6-bedroom house, 4 and change weeks in a month, you might have 30 payments, partial payments, all these different things, late fees. It's a ton of noise for the landlord that they do not want to deal with. So we aggregate all that. We have a collections team in-house that handles all that. And then we pay out once to the landlord. So they can still say to their bookkeeper, okay, here's the one payment. Hey, lender, here's the one payment, and so on. And they don't have to think about it as much. But it makes it more customer friendly. And it's how we maintain such high collections rates, which is hard to do in a sometimes subprime market. But we're able to keep 97% collections rates, we believe, because we're hyper focused on making it as easy and painless as possible for people to pay.
As part of my research, I saw that you guys are offering rates. It's not technically you guys, I suppose it's the host, but
Sure.
the platform in general, a PadSplit unit, is offering rates roughly on average nearly half maybe of Airbnb is kind of like what I saw in some markets. But
Sure.
it seems that the hosts are still getting really good returns. So those kind of seem like opposite sides of the coin. So how does that work?
Yeah. So the main reason is there's two. So one is occupancy rates are higher. So in most short-term rentals, if you're getting great nightly rates, okay, fine. But maybe you're just doing weekends or so on, or you're not always full. Certainly, in general, occupancy rates on Airbnb are going to be a lot lower because there's seasonality and all those sorts of things. So that's part of it. Second piece is the operational tempo and cost structure is just much lower, right? It's a different product, right? You're not doing cleanings, every third day as people come out, all those sorts of things. So maybe you do a monthly cleaning, but it's just much lower operational tempo. Your utility bills tend to be much lower because you're setting the thermostat and kind of keeping things normal, and you're not putting bottles of water and mints on the pillows and all those sorts of things. It's long-term tenants. So it's not a vacationer who's really, really, persnickety about their experience over a couple of days. It's someone who's going to be there for a while. And then the other piece is just the asset cost. So we're in different types of properties. So, the beach house that, rents for a ton on Airbnb, that's great. Airbnb is probably the highest and best use. That's what I would do with it, maybe, but it's not the best PadSplit, right? We're in different kinds of neighborhoods, bigger houses where you don't really get paid. I mean, there's an asset strategy to it in that, if it's a 2-bedroom house, hey, you should probably Airbnb it or a traditional rental or whatever. If it's a bigger house where you make money by the bedroom, well, then it sort of changes because Airbnb, you can charge a little bit more for a bigger house, but you're narrowing who wants a 6-bedroom house in this given neighborhood. Maybe your occupancy is lower, but it's not like you make double what you would for a 3-bedroom house. You make a little bit more. The same thing for traditional rentals. You might charge a little bit more for a 4-bedroom than a 3-bedroom or a 2-bedroom, but not much more. Whereas for us, the revenue generating unit is the bedroom. So as the bedroom count climbs, for us, it's more or less kind of pure profit.
When it comes to choosing who gets to stay in their property and also what rates to charge, who decides that? Does PadSplit tell the investor who they have to allow in the property and also what they have to charge, or can the investor choose that?
Yep. So the pricing is entirely on the host. So they set the pricing. They can do whatever they want. We have a pricing recommendation that they can use or not use, but they want to charge $1,000 a week, they can. I don't think they'll fill the room, but that's fine. Free country. Now we do constrain how quickly, how frequently, and by how much hosts can raise prices. So that is constrained by the system. So if you set $150 a week, you can't change it to $200 a week the second week. That's so that we do constrain, but the prices they set, that's fine. The screening is something that's actually evolving a bit. We started by doing all the screening for hosts, but we always knew that was something we needed to hand off. And for two reasons. One is people want to be involved. They want to control who's in their properties. And the second is people might look at it differently or want to do themed houses. You might have a female host who wants a female only house and all sorts of reasons, or veteran only housing and all sorts of things. So to give hosts that flexibility, we've rolled out a screening feature. We're going to make it more robust kind of this year, but it's giving them more control. So we still do a background check. We still do a income verification, employment verification, identity verification as a baseline, just to be able to request to book a room. But now again, some hosts toggle it off. They can do auto approve or not. But assuming that they're not auto approve, it would come to you as the host, and you'd say, "Oh, here's Frank. Decline." I don't know, maybe approve. Who knows? And, we don't show everything per se. We hold back some of the information for kind of privacy and fair housing reasons, but the hosts have control over who's booking.
Who's doing the property management and, paying all the bills like utilities, property taxes, etc.?
The host, just like Airbnb. Now, again, just like Airbnb, or I should say, maybe not just like Airbnb, but most of our units are professionally managed. So, you might be the owner, you could be in New York or California and have a unit in Atlanta. There are property managers here, and it's part of that ecosystem I talked about. He'll say, hey, I'll be your host. You'll own it, whatever. I'll be your super host, and I'll respond to the maintenance tickets and do this or that. And you'll see the financials or, whatever, you still have a login, but you're not fixing the leaky sink or whatever. And so that's how most of our hosts or, their owners operate, is professional property manager. They're managing the unit, owners elsewhere in town or whatever. And that, it really kind of depends on them. Some of the owners are really involved and some are not, on their boat, whatever. And that's fine too. So it just kind of depends, and different property managers charge differently, different models. We've had people do profit shares, we have people do percentages, people do cost plus, it just really depends on what kind of works for them.
It says on your website that you don't have a minimum credit score requirement, nor do you require a large security deposit. This is a bit different than many traditional rentals, which I guess is your point, but it makes me wonder what that leads to for tenant quality. What else do you look at when you're screening potential tenants?
So we are still checking credit, and credit can get people declined, right? Or evictions or what have you. It's more just a point that we don't have a hard minimum credit score. And a lot of that is that many of the residents who we have are thin file, right? It's, 40% are unbanked. So we have folks who essentially don't have a credit score, who apply and they have income and demonstrated income, and that's, but they just don't really have a credit score. And so we have to tailor our screening approach and what our hosts do in their screening approach to the demographic a bit. So, a FICO score is really designed to know if Robert will pay his mortgage, over the next 90 days kind of thing. And it's maybe representative. It's not that it doesn't have value, but is it the most relevant thing for someone who's working an hourly wage or, night shift job in Houston? And the answer is maybe not. So we do look at credit data. Do people have accounts and collections? Is it medical versus student debt and all those sorts of things? We have our own kind of way of looking at it that is just separate from a credit score, but more or less pulls from similar. It's the raw credit data that goes into it. So that's definitely important. Now we also we do income verification. So we have a integration with Plaid, if you're familiar with their service. People log into their bank account. And so we're pulling, hey, how much money's coming in? Because that's really what's important in a lot of cases, more so than the credit score. And so we do that, or if people are unbanked or don't do the login, we will verify manually with pay stubs. So there's a back and forth on it. It's not perfect. Obviously, the reality of anything in housing is tenant quality is super important and also super hard. And so it's a risk factor that we bake in, and hosts have to bake in. And part of it is we've gone through a really weird couple of years between COVID and inflation and, all this sort of stuff, and eviction moratoria and all those sorts of things. And so, our view is, look, we've had people get evicted from PadSplit houses. It happens. People fall short. Our members are people. They are cut from the crooked timber that is humanity, and sometimes they do fall short. But even if there's one eviction in a house with 6 bedrooms, well, you have 5 units that are cash flowing. So it's almost like an apartment deal where, hey, it's a problem. It's not anything to celebrate, certainly, but you can still make your debt payment. You can still kind of cover it because the rest of the unit is cash flowing and so on. So there's a little bit of security in the diversification there, but it's an evolving challenge. Honestly, we're always collecting more data. We've had over 10,000 stays so far in our network, and the model's kind of always getting better. What works, what doesn't work. It's not perfect yet, though. I wish I could tell you it is, and we know exactly based on an application who's gonna pay, who's not. But I'm always hoping to just improve our batting average a bit.
I'm assuming that just given that the hosts are managing, that they handle the evictions, but what does the eviction process look like in this kind of model?
Yeah, so they do. We have a third party provider who does handle the process for folks if they so desire in any state or any state that we're in anyway. But the process is exactly the same as any other eviction process. Now, hopefully it never gets there and you can kind of talk someone out. And we do have a pretty heavy lift in what we call the easy way, hard way conversation with folks when we get there. Because ideally for both tenants and landlords, you never get that far. It's kind of better for everyone if no one has an eviction on their record because they left ahead of time. But process is exactly the same. You file the same way, you give notice the same way, you file the same way, it goes to the judge the same way, and they render judgment the same way. The only difference is depending on where you are, there's usually like a checkbox that says end all occupants of the home, and you don't check that. And then the dispossessory is just for Frank Furman and not for the house, if that makes sense.
Yeah, so you're not getting rid of everybody else that's in that whole house. You're just getting rid of that one bedroom.
Exactly. I've had people come up and say, it's impossible to do that. You can't evict one person from a house. And it's like, sure you can. We know it's true. And also, you figure if I crashed on your couch and then never left and you couldn't convince me to leave, you could get me evicted from your house. Hopefully I wouldn't do that. I wouldn't. But, it is possible. You can do it anywhere. It's not, it may be new to investors, but it's the same exact process.
It's often discussed, I want to go back to credit for a second. It's often discussed how our credit reporting system in the US is a bit flawed for not counting things like rent payments, utilities, et cetera. People, it's kind of a joke, kind of a meme, but with a serious kind of undertone to it is that like people will be like, oh, I can pay $2,000 a month in rent. And I've done that for 5 years, but I can't afford a $1,500 mortgage payment. It's like, according to the bank. Yeah. So there is definitely, there's some flaws there. And honestly, I kind of agree with it. As a landlord, I own rental properties. I'd be more than happy to help my tenants improve their credit score if they pay rent on time. I think that is a great kind of incentive model for them to help. It helps me and it helps them. So your model with PadSplit actually does just that by helping people improve their credit scores. How does that work?
So the short answer is we outsource it. We have a partnership with a company called Isuzu. We got to know their founders, Samir and Abby, really well. We were in a housing innovation cohorts at UC Berkeley a couple of years ago. They built a great company that does exactly that for landlords. So we essentially send them the data every month and they report it to the 3 bureaus and they handle it all for us. We do it for exactly that reason as a service to our tenants. But to your point, it is, we're not huge or whatever, but we're at a certain scale where that's worth it. It is hard. I mean, I would say that for all the griping about credit scores, our system is so much better than anywhere else in the world, even if it's still pretty bad. Credit scores are a thing that almost don't exist in any other country, and I've lived abroad. I lived in London and so on. And ours is imperfect, but it's unfortunately about the best the world has to offer on that front.
Credit scores do exist in London, though, no?
No, not really.
Interesting.
I thought they did. There may be a little bit more of it now, but it's a much more nascent industry in Europe than it is. And some of that is due to national borders and all those different things. Our system isn't perfect to be sure. I've got my gripes, but it's, you figure in most of the world, take the mortgage industry, plenty of issues. Ours is by far the best in the world. It's, in most of the world, you have to pay cash for houses. There is no mortgage industry. So yeah, we've got challenges, but it's, there's a healthy bit of perspective there sometimes for some of it. But yeah, this is a thing that landlords can do to make it a little bit better, I think, and make it better for tenants and so on. And the other piece of it is sort of a fairness thing. I want good tenants who pay all the time to see their credit score get improved. I want tenants who don't pay to see their credit score dinged. I think, the next landlord should know, and the next lender should know that someone hasn't been true to their commitments. So yeah, I mean, I think it's super important. That's why we do it. But the easiest way we think is to outsource it. There's a few other companies that do it, but we like the guys at Isuzu, so we use them.
It's a bit of a detailed question. You might not have the answer, but do you know how it's reported on somebody's credit report? Like, does it say PadSplit? Is it the property? Is it the name of the company that's doing the reporting? Like, I'm curious how that works. And then like, if they go from one PadSplit to another, like, does that change as a line of credit? Like, is it a different line? Like, how does that work?
Yeah. So the short answer is it says PadSplit. It doesn't say the reporting company. It doesn't show the property. And it doesn't matter if they transfer between properties because for all intents and purposes of what's reported, it's just payments, and it's all to the same entity. It's through the same payment processor, whether it's your property or my property or the next property. So we do have people transfer between properties, but it wouldn't impact that. The good thing about our system and kind of the weekly payments is it's a lot of data points really quickly. So whether that's fair or not or what have you, over a year, most of our residents are getting 52 data points. So if they're paying on time, they can build that credit score really, really quickly because instead of 12, they're getting, 52.
Yeah, it's really interesting. As a founder, real estate investor, businessman, do you like to read? And if you do, what do you like to read? It could be business related or not. What kind of books have been the most impactful for you?
So I do read every year. I set my annual goals on my birthday every year. And I have a recurring goal every year to read 20 books and I sort of track them. And it's sort of a nerdy thing that I do.
Why 20?
It's achievable, I guess is probably the answer. Yeah, it's just more to keep, I don't stop at 20. If it's my birthday's in May, if it's, March and I hit 20, I don't stop. And if, to be honest though, if it were mid-May and I were at 15, I wouldn't stop working and just read, so it's more just a target to track, but I do always hit it though, for the record. But I do. So I love to read. It's kind of a little bit of an escape for me, more so than some other things, but I don't really like to read business books, to be honest. I used to be a management consultant and would occasionally get forced to read one by some client, and sort of broke me on reading. I'd have to force read, some random business book over a weekend.
Yeah, it's like reading in school when they used to force you to read in school.
Exactly. And everyone hates it. So I only read for pleasure. So I do read fiction. I also enjoy nonfiction. For example, all my interests are weird. That's just kind of my thing. So for example, one of my favorite, not really business books, but about an industry that I really find interesting is this book, Junkyard Planet by Adam Minter, that I read recently. It's about kind of the scrap and waste industry, and it's super fascinating. I mean, so it is nonfiction, and it's he was sort of the son of a scrap dealer who became a journalist, and it sort of tracks. Hey, here's a Christmas lights that were sold in Wisconsin, or that were trashed in Wisconsin, and they get bundled up and sent to China, and they scrape off the insulation and turn into sandals, and then they take the copper and do this. And so super fascinating. It's not for everybody, but it's for me. And then I like my sort of trashy thrillers and spy novels, for when I really want to just kind of unplug. And
are you a Sherlock Holmes fan?
I've read some Sherlock Holmes, but I'm generally, I would say, more modern or modern-ish. I love John le Carre's novels. I've read probably almost all of them. He just passed recently at like 90. Yeah, I kind of go across the board, but I like to, branch out and do kind of new stuff. But
I exclusively read business books. Like that's
okay.
It. That's all I read, business or investing. And I think I need to broaden my horizon a bit. And I ask about Sherlock Holmes because I recently watched I think it's a TV show about Sherlock Holmes. I loved it. And then I bought the books, a bunch of I love going to old little like bookshops, like not Barnes. I like to go to Barnes and Nobles too, but I was in New York City. They have all these little like hole in the wall little libraries, or bookstores, and it's awesome. And they had some awesome like old school Sherlock Holmes. So I bought them, but I haven't read them yet. Like the only thing I read, I've never read a fiction book like outside of school. It's just always business. So hearing that from you, I think it's just another push that I need to give that a chance. But
I find the pros of those a little bit dated, but it's still pretty good. There's a lot of them are pretty short. They're more like short stories in a lot of ways. But yeah, you should definitely read fiction.
Yeah, I might have to give it a shot.
Yeah.
So why did a client during management consultant have the right, like, why were they telling you to read a book? Like, what is that there?
I think it's the kind of thing where, so I was, worked for McKinsey in London and then later in Atlanta. And, you go in and it is truly client work. What the client, they want a ham sandwich, you get them a ham sandwich. I mean, mostly you're making slides and spreadsheet models and so on. But, client says, hey, this is interesting. You're like, of course that's interesting. Let's talk about this thing. And look, some things are super interesting, but there's just a certain type of client who will be like, hey, I read this book, this business book, you should really read it. And, the partner on the project will be like, you should totally read it so you can talk to him about it. So you read it over the weekend. You're like, I really loved in chapter 4 how he talks about being yourself to be a good leader. That's pretty good, or whatever the thing happens to be. And you do it. I don't know. I don't mean to make it like, I actually loved the work that I did in a lot of ways and found it super interesting. But you have these short engagements of 6 weeks or 8 weeks or whatever, and you go in and you work like crazy and you work, 60, 70 hours a week and you're with these clients all the time and so on. You have these kind of shrink wrapped relationships and, you find things to talk about and to, sort of build the infrastructure of a long-term relationship and hopefully follow on work. And so, if someone says, hey, this is my interest, whatever it is, whether it's a business book or it's, hey, I really like this soccer team or whatever.
Going to learn golf or whatever.
Yeah. You Google it and you're like, man, how about the team? Pretty good.
So it's more like rapport building and relationship building than it is like, hey, you got to go write a book report on this book.
Totally. Yeah. And the thing with, it's not to write a report on. Some of it's just in theory to get some insight into what's important to them and how you sort of, you always want to speak in someone else's language, just kind of like a communications truism. So if someone says, hey, I really like this book about X, I loved it. You're like, okay, these are things that they think are important, probably. So if it's, whatever, you're like, okay, this is the medium that they appreciate. This is kind of the messaging that they like, whatever. Now, when I'm talking to them about this change management program or cost optimization program or whatever my work is for them, let me try and use that to best my ability. That's the theory. In reality, it's pretty hard. And I don't know if it ever really works, but that's the idea.
Yeah, it makes sense. Well, Frank, as we wrap up the show, I want to give you a chance to tell everybody listening today where the best place is to find you, maybe learn more about PadSplit, basically direct the audience anywhere you want them to go to find you.
Yep. So I am super easy to find. You can go to our website, padsplit.com. Super easy to find. I'm just Frank at padsplit.com. So I'm maybe even easier to find. We also have a promo offer for listeners of this podcast. Special. We're offering free professional photography of your PadSplit home with the promo code podcast1. So, PODCAST and then the number 1. Our marketing team is very intent that I get that out to people. But yeah, I'm super easy to find. Frank at padsplit.com, padsplit.com. I can't hide. I'm around.
Awesome. I'll put links to all Frank's social media, website, email. I'll put the coupon code, everything he just mentioned, anything else we talked about in the show notes below for anybody that's interested in checking it out, learning a bit more about PadSplit. I don't know for sure if it's something I'm going to do myself, but I think it's something I'm definitely going to be looking into. I think it's a really cool and interesting model. Definitely something I'm interested in. So if you're listening today and you're interested in it, definitely recommend you check out PadSplit. Frank, thanks so much for joining me.
Robert, appreciate the time. Thanks for having me.
When I think of becoming the best real estate operator in the world, I really think of treating property as how can we most efficiently run this property so that we are as capital efficient as possible, as people efficient as possible,